even if you just glance at the news, you've probably felt some serious financial whiplash lately. We're seeing these incredibly sharp, really dramatic moves in things like the S&P 500 and bond yields too. The volatility.
It's been intense.
Yeah, truly historic, actually. We
Mm.
looked at the data, specifically those really big daily swings.
Hmm.
They were in the 99th percentile of changes going all the way back to 1990. That's not just a bit choppy. That's like a once-in-decades kind of move.
Exactly. Not your typical market storm.
Which is why we really need to unpack what's going on under the hood, what's actually driving the shockwave. That's our mission today. Welcome to everything you need to know about finance.
So just a quick note before we dive deep. Everything we're discussing is based on the detailed market research and data we've analyzed. It's about understanding the information. This isn't financial advice tailored just for you.
Absolutely. And hey, if getting this kind of insight quickly is your thing, please do like and subscribe. It helps us keep doing these deep dives.
So this volatility, it hasn't exactly come out of nowhere, right? It's been sort of bubbling under the surface for a few years. We've seen these big policy events. Think about those pretty aggressive trade tariff announcements linked to the new U.S. administration, or even the ones back around April 2nd, 2025. Those can jolt the market just as much as, the classic Fed moves.
Okay, but focusing on this specific 99th percentile event, what was the main trigger? What really lit the fuse this time around to cause such an extreme reaction?
Well, fundamentally, it almost always circles back to one thing: interest rate expectations.
Right, the big one.
Yeah, let's break down how that works, how those shifting expectations can trigger such immediate selling. When rates go up, or even when the market just thinks borrowing will get pricier soon, it hits stocks in two main ways. First, pretty obviously, it costs more for companies to borrow money. That pinches their profits, slows down investment.
Makes sense.
But second, and this is the part that really tends to annihilate growth stocks, higher rates crank up the discount rate.
Okay, explain the discount rate a bit more.
Think of it like this. A company's value today is largely based on the earnings it promises to make way out in the future, right? Especially for tech or growth companies.
Yeah, often years down the line.
Exactly. Now, if the interest rate, the return you can get on something safe, like a government bond, goes up, the value today of that money you expect to get way out in, say, 2035, it suddenly becomes worth a lot less.
Ah, I see. So the future promise gets heavily discounted because you could be earning more safely right now.
Precisely. And that high-flying tech stock, whose value is mostly tied to that distant future potential, its present value just collapses when rates jump.
And at the same time, those safer bonds start looking way more attractive, pulling money out of the riskier stock market.
That's the dynamic. Money seeks safety and better relative returns.
Okay, but here's the confusing part right now. The Fed did just cut its benchmark rate, didn't they? Moved it down into that 3.75, 4.00% range. So how on earth did a rate cut lead to this kind of violent 99th percentile sell-off? That feels backwards.
It's a classic case of market expectations versus reality. Think of it like investors were expecting champagne, and the Fed delivered sparkling water.
Ah, okay.
The market had essentially priced in, meaning big investors had already positioned their money for a really accommodative Fed. They were betting on, faster, more consistent rate cuts through the rest of 2025.
So they got the cut, but
when the Fed announced that cut, they also sent some strong signals, suggesting that further cuts might be fewer or slower than everyone had hoped. They sounded really cautious about the future path.
so it wasn't the cut itself, but the message about future cuts that spooked everyone.
Exactly. That signal was seen as the opposite of the easy money policy the market wanted.
Yeah.
And the second that expectation shifted, the whole narrative about future growth, future earnings, it just flipped instantly. That triggered really aggressive selling.
Okay, so why are they being so hesitant? If inflation seems to be maybe cooling a bit, why not give the market the reassurance it wants about future cuts? Is the market just overreacting again?
Well, they're looking at the data coming in. And yes, some inflation measures are sticky, but we're also still seeing a surprisingly strong labor market. Plus, other economic data in areas like services looks pretty robust. If the economy's holding up okay.
Then the need for lots of aggressive rate cuts isn't really there from their perspective.
Right. They're trying to walk this tightrope, avoiding a mistake that could accidentally reignite inflation if they cut too much too soon while the economy is still humming along.
Okay, that makes sense. So the Fed's cautious tone was the spark. But what turned that spark into this, 99th percentile explosion? Let's talk about the other factors amplifying this. Policy uncertainty must be a big one.
Absolutely. That's the other major driver here, beyond just rates. Policy uncertainty is definitely amplifying the volatility. Think about the shifts with the U.S. administration in 2025. There's renewed talk, threats even, of more aggressive protectionism.
Like new tariffs.
Exactly.
Yeah.
Potential new trade tariffs, maybe on specific imports or even green energy components. For big multinational companies, that creates huge uncertainty about their costs, their supply chains. It just muddies the waters completely.
And that political uncertainty feeds straight into the bigger economic guessing game, right? Are we getting a soft landing, a hard recession, or that dreaded stagflation?
Precisely. When policy itself feels unpredictable, the odds of those different economic scenarios just swing wildly day to day. And that leads to these massive index moves we've been seeing.
And this kind of volatility is especially dangerous when the market structure itself is a bit fragile, isn't it? Which brings us to concentration and valuation.
That's a key point. We know a huge chunk of the market's gains over the last couple of years came from just a handful of mega-cap stocks, mostly in AI and tech.
The usual suspects.
Right, and the market is starting to seriously question if those valuations, those bubble-like levels in some cases, can actually hold up.
So if the whole S&P 500 is leaning so heavily on just a few giants trading at really high prices.
There's just no room for error.
Yeah.
Any piece of bad news for one or two of those big names gets magnified instantly across the entire market. It's structurally fragile.
And that fragility helps explain the speed of these 99th percentile moves.
That's exactly it. The sheer size of the unwelcome moves, as analysts call them, not just the S&P dropping, but seeing the VIX spike simultaneously, that combination was historic.
Remind listeners quickly what the VIX tells us. It's the fear index, right?
Yeah, essentially, the VIX measures the market's expectation of volatility over the next 30 days. So when the S&P falls sharply, the VIX usually spikes sharply upwards. It reflects panic, high anticipated risk.
So seeing both hit those extreme percentiles means the selling wasn't just deep, it was incredibly fast and panicked.
Right, extreme velocity. And that speed brings us to maybe the most critical amplifier, especially for these really sharp, sudden moves, derivatives positioning, sometimes called gamma risk.
Okay, gamma risk sounds technical.
It can be. But think of it like this. Many big institutions use options derivatives to hedge their bets or make short-term plays on market direction. When the Fed sent that cautious signal, it likely triggered forced selling, or maybe even buying, by the market makers who provide those options. They have to rebalance their own books instantly when the market moves unexpectedly past certain price levels.
So it's like a chain reaction. The Fed news causes an initial move, which then forces these big players to sell even more, making the move bigger.
Exactly. It's like fuel on the fire. The Fed signal was the spark, sure, but the way investors were positioned, maybe heavily leveraged in certain options, it created this potential for a violent, almost self-fulfilling explosion. That technical unwinding is a huge reason why we saw a 99th percentile shock, likely much bigger than fundamentals alone would justify.
That really highlights the hidden dangers in market structure.
Okay, so if we step back and look at where we are right now, say around November 6, 2025, the overall U.S. market, like the SPY tracker, is still pretty elevated, right? Around $677 or so.
That's right, it is. But that feels like a massive contradiction. We've just described historic volatility, fragility, technical risks. Yet the market's still trading near highs. Why hasn't it collapsed further? Are investors just ignoring all these warnings?
Well, they seem to be anchored to the positives that are still out there. Corporate earnings, for instance, have actually held up reasonably well for most companies, not just the tech giants.
Okay.
And U.S. consumer spending, while everyone's watching it closely, it's remained surprisingly resilient so far. Plus, there's still this underlying belief that the Fed will eventually cut rates significantly, just maybe not as fast as initially hoped.
So the hope for future cuts is still providing some support.
It seems so. The general view among analysts now is that the rest of 2025 is likely to be, well, range-bound. Limited upside because valuations are still high and rates are sticky.
But also limited downside.
Potentially, yeah, because that underlying economic data is proving fairly resilient. So maybe trading sideways, but with some very sharp bumps along the way.
But the risk profile, it still feels pretty severe. With those high valuations, the chance of a real correction, a 10% or more drop, that's still very much on the table, isn't it?
Oh, absolutely. It's non-trivial. Any significant policy misstep, like a sudden, unexpected tariff or some external geopolitical shock, could easily trigger another one of those major spikes in volatility. The market's on edge.
And are we seeing shifts within the market itself in terms of which sectors are doing well?
Yes, definitely. There's a noticeable shift happening under the surface sector rotation. For years, it was all about tech and pure growth stocks leading the way.
Right.
Now we're seeing money start to move into sectors that might actually do okay or even benefit from this environment of more persistent inflation and higher rates.
Like which ones?
Think financials, they can benefit from higher interest rate spreads. Industrials, maybe utilities too, they tend to be a bit steadier and often have more power to pass on rising costs.
So a move towards value or quality, perhaps.
Exactly. This rotation adds to the short-term choppiness, of course, because it's messy. But arguably, it's a necessary adjustment towards a potentially healthier, less concentrated market structure long-term.
Okay, so let's bring this all together. We've got extreme volatility, technical risks blowing things up, shifting Fed expectations, policy uncertainty. What does this all mean for someone listening just trying to navigate their investments through this?
Right? The practical takeaway, well, first, and this is probably the hardest but most important, especially for long-term investors, try to stay invested. This kind of volatility feels awful, but trying to time the market jumping in and out is incredibly difficult, maybe impossible, especially when these huge swings are driven by sudden technical factors like those gamma unwinds we talked about. Panic selling is usually the wrong move.
So write it out, maybe add incrementally if you can.
That's generally the advice for a long-term horizon. Second, diversification is absolutely crucial right now. If your portfolio got really heavily weighted towards those few big tech names,
Which happened to a lot of people.
it did. Now is the time to really think about broadening out. Look across different sectors, different
Right.
styles like value and quality, not just pure growth, maybe even different geographies to spread that risk, especially the discount rate risk.
Yeah, third.
Third, really focus on quality. In this kind of environment, higher rates, more uncertainty, borrowing costs that actually matter again, companies with strong finances, solid balance sheets, sustainable earnings, and crucially, the pricing power to pass on those sticky inflation costs to their customers. Those are the kinds of companies likely to weather these storms better. Companies drowning in debt, they could really struggle.
Makes sense. Looking at a bit further then, say the next 3 to 5 years, is this just the new normal? Are the days of relatively calm, low volatility behind us for a while?
Well, structurally, there's still a lot to be optimistic about long term. Those major technology themes, AI, automation, the whole digital transformation, those are powerful forces that aren't going away. That underlying growth story is still pretty solid, regardless of the Fed's next few moves or tariff threats.
But the ride might be bumpier.
That's the consensus view, yeah. The feeling is that the future, at least for the medium term, is likely to feature a higher baseline level of volatility compared to, say, the relatively calm 2010s. Interest rate policy will probably remain more dynamic, more uncertain, and those technical market structure risks we discussed, they're likely to keep amplifying moves. So managing risk effectively becomes sort of a permanent part of the investing landscape, not just a temporary tactic.
Okay, so higher volatility is the new baseline. That's a crucial takeaway. To wrap this up, let's end with one final indicator. Since we know these huge 99th percentile moves aren't just about fundamentals, but heavily influenced by technical positioning, what's one signal listeners could watch that might hint when that technical risk is getting high?
That's a great question. I'd say watch for signs of extreme positioning in the derivatives market, particularly options. That's where that gamma risk builds up. When you see signs that investors are really heavily leveraged using options to make big bets on relatively small market moves, either up or down, that's creating the potential for that self-fulfilling prophecy.
Because if the market moves against those big, crowded bets.
Exactly. The forced unwinding of those leveraged positions is what can generate that incredible 99th percentile velocity. So keeping an eye on indicators related to options positioning, or even just the VIX itself staying elevated, can sometimes tell you more about the potential for a sharp shock than just looking at company earnings alone. It's about risk perception and positioning.
Fascinating. A really comprehensive look at the complex forces shaking up the 2025 market. It's clear that this volatility isn't just about interest rates. It's a potent mix of policy, market concentration, and those explosive technical mechanics under the surface. If you found this deep dive valuable and want more analysis like this on complex topics, definitely try out our latest episodes. You can find them wherever you get your audio content. Thanks so much for joining us today.
Thanks for having me.
We'll see you next time.